In this presentation, we will take a look at part one of an example problem related to a not-for-profit hospital. We're going to be taking a look at financial transactions related to our not-for-profit hospital. We're going to have the information up on the left-hand side. We're going to be journalizing the journal entries down below and then posting those journal entries to our trial balance worksheet on the right. The trial balance worksheet will be in order. We have the assets in green. We got the liabilities in orange. We have what would be the equity section in a for-profit organization, which would be here, the net assets section in our not-for-profit hospital in the light blue. Under that, we have what would be the income statement section, revenue and expenses in a for-profit organization, very similar in our not-for-profit hospital. Those temporary accounts, those revenue and expense, those measuring accounts over a time period, which would then close out at the end of the time period to what would be the equity section, or in our case, the net assets section. Down below here, we're going to show the change in the temporary accounts, which would be similar to the income statement or net income type of number. That's going to be the sum of all of these dark blue items, and we note that the debits will be in positive numbers in our trial balance, the credits negative. This green 0 indicates the fact that the debits minus the credits is 0, which means that we are in balance. The double entry accounting system is working. As we record these transactions, we're going to record these transactions as basically lump sum type transactions for the types of transactions that would happen throughout the time period. So in other words, oftentimes there would be many little transactions or smaller transactions that would happen with regards to the revenue cycle, the purchases cycle. We're going to record those in one lump sum type of transaction so we get the idea of what the transaction would look like. We can limit the length of the problems that we will be going through and concentrate on those areas where the not-for-profit hospital would differ from a for-profit type organization. We have the patient service revenue. This is going to be patient service revenue that we have received on account. So we're going to record this on account, all the transactions related to the patient service revenue received on account. We will record this similar to if we were to issue an invoice for a for-profit type of organization, in which case we have not yet received the cash. Therefore, the debit's going to go to another asset account, that being accounts receivable. The credit then going to the patient service revenue. So that's going to be included in part of this accounts receivable debit. And then the credit's going to go to the patient service revenue, increasing the revenue account. Both are going up. Accounts receivable is a debit balance account. It'll go up in the debit direction. A patient receivable, the patient service revenue is a credit balance account, a revenue account, and therefore it'll go up with a credit balance. Then we have the contractual adjustment to patient services. So the contractual adjustment will typically be the fact that there's going to be an adjustment down to the patient services. So that means that the accounts receivable, and you could think of the patient service in a way, is overstated, because we're saying that when we recorded it, we credited the revenue and we debited the accounts receivable, and now there's an adjustment to it. So you would think then that we would reverse these two accounts. So that's going to be taking out of accounts receivable decreasing. The other side you would think would be decreasing the patient service revenue, netting those two out. However, instead of decreasing the revenue account, as we typically do in a for-profit organization, we are making another account, which is called the contractual adjustments. So therefore, we're going to debit the contractual adjustments, and that's going to be reducing. The credit then would go to accounts receivable. In this entry, you can see that it's going to be a reduction to the accounts receivable. So the accounts receivable, that's going to be like our plug type of entry as we record all of these in one transaction. And then we have other operating revenues. The other operating revenues we're going to put into another type of revenue account, other operating revenues, crediting that account. The debit there too, as we're going to say it was received on account, we didn't get the cash yet, then debiting to the accounts receivable. So the accounts receivable we can think of then as going up by the 350 to 800 plus the 300 increased by those two, but then it's going down by this amount, the contract adjustment minus the 1528000. That's giving us the debit of the 2,978,350. So you might want to think of these as three separate transactions. We're grouping these transactions together here in our one total transaction. So if we were to record this out, then it's going to look like this. We're going to say the accounts receivable, it's going to be going up. Here's the accounts receivable. It goes up in the debit direction. Then we have the contractual adjustments. Contractual adjustments is down here. It's going to be basically kind of like an expense type of account, and it's going to go up in the debit direction. As it goes up, it decreases what would be like the net income number. Then we have the patient service revenue, which is of course a revenue type of account. It then going up in the credit direction. As it does, it of course increases the net income type number. Then we have the other operating revenues. It goes up in the credit direction as well. And once again, as a revenue account, it increases the net income type number. These three blue accounts down below that we have filled in so far, all the blue accounts, the dark blue accounts, is what makes up this net income type number down below. Note that it is currently at income, not a loss. The brackets representing credits, not representing a loss or negative type of number in that fashion. So we have net income here of the $2,978,350. Next transaction, we have interest on investment in assets limited to use. So these are going to be cash received. And then we have the collections of receivables. So let's think about the collections of receivables actually first, because that's going to be the standard type of transactions we would expect in our basically revenue cycle. The last transaction we recorded in one lump sum, the receivables on account, increasing the receivable, increasing the revenue. The next step in that process would typically be that we get paid. So this once again representing for the entire time period all the transactions that would result in the standard payment transaction, in which case we would get cash, debiting cash, and typically decreasing then the accounts receivable, the account representing that money is owed to us. Therefore, we're really only looking at these two accounts here. The receivable account, one asset account, decreasing. The cash account, the other asset account, increasing. Then we have this other cash that was received for interest on investment in assets that were limited to use. So we have an investment. The interest on it is going to be limited to use. There's some kind of limitation on it. Therefore, we're actually going to record that in a separate cash account. So we got cash, the investment earned investments. So you could say it earned something like interest income. And so the investment, the cash is going up. So we have the cash down below, but we're going to put it into another account, cash, which is limited to use. And then the credit is going to go to the investment income without donor restrictions. So investment income without donor restrictions. If we post this out, then it's going to look like this. We're going to see that we have the cash. The cash is going to be increasing in the debit direction. So we increase the cash. We then see the cash limited to use. So cash limited to use increasing in the debit direction. Then the accounts receivable. So accounts receivable has a debit balance. We're making it go down. So the accounts receivable is decreasing. And we have the investment income without donor restrictions. It then going up in the credit direction. As it goes up, it will be increasing what would be like the net income. So you can see this increase down below by the $8,350. Notice that that's the only amount of this transaction that has an effect on what would be the net income. Next transaction. In this transaction, we're going to group together basically most of the expense type of activities. Once again, in one type of transaction, you'll note that, of course, as we record expenses through the time period, we'll typically have similar transactions that will add together into a lump sum. But we're going to basically put this in one transaction for the expenses and the related basically adjustments to accounts payable as we go. So we have down below, we're going to start here with the administration expense, the general service expense, the nursing expense, and the other professional expense. So we'll start there. So the admission expense is going to be a debit. We have the general service expense is going to be a debit. We have the nursing service expense and the other professional service expenses. Those are going to be the debits in their respective expense accounts, as we can see down below. Note that these expense accounts are being reported basically by function here on our financial statement. Then we're going to have the expenses recorded in accounts payable. So the expenses of these expenses, in other words, we're basically saying they were purchased on account. Therefore, the credit then going to accounts payable. So we're debiting basically the expense. We're crediting not cash, but on account accounts payable. And then we have the expenses recorded in the accrued payroll, that being the $1,462,000. So part of these expenses that are being allocated to the admin, general nursing, and other are for payroll expenses. Note they're being reported here not by nature, but by function, not by payroll expense, but by admin, general nursing, other. And then the credit then is saying we haven't yet paid the cash yet, crediting therefore the accrued payroll of the 1,462,970. Recording this out, then we have the admin, the general, the nursing, the other. These are going to be the debit amounts for the expenses. Here are the expenses. They are all increasing in the debit direction on the income statement, or similar to income statement type of activity here. If we were then to look at the adjustment to the what would be net income number, we could see it went way down. This is a net income, went down by this, down to the 629,410. Still income, net income, not a loss. Credits are winning, credits over the debits. This is income. But they went down, of course. And then the other side being to the accounts payable and the accrued liabilities. Both of these are going to be liability accounts. They have a credit balance. We are doing the same thing to them, crediting them to make them go up in the credit direction. Next item, we're going to say that the amount released from restriction because of some of the expenses met a net asset restriction. So that basically is saying that all of these items that we have put into place, some of them have met the restriction requirement for some revenue accounts, and therefore we need to remove that amount from a restricted amount to unrestricted. In other words, at some point in time, we had some restrictions, and when we received some type of income, we recorded it in income in a restricted fashion, and it would be reflected in the income account and or in the net assets with restrictions. Now, the restriction has been met by us paying in one of these expense categories. So we've met one of the restrictions. Anytime that is the case, we want to make sure that we unrestrict by using these two accounts. These two accounts down below are going to help us to go to that unrestricting process. Those two accounts are called net assets released, satisfaction of purpose restriction with donor restrictions, net assets released, satisfaction of purpose restriction without donor restrictions. Key term being without and with. So either without the restrictions or with the restrictions. Note the purpose of these two accounts is always to unrestrict. Therefore, they'll always be going the same way. We restrict things when we get the money. If there's some type of restriction on it, then we unrestrict with these two accounts. So you want to think of these, I would think of them as kind of like revenue accounts. So the revenue account being an increase, or you could think of this as a revenue and this is an expense if you so choose. But the revenue account, the without restriction, is always going to go up. It's going to go up in the credit direction. So this negative number representing a credit, like the revenue, is increasing. That's going to be an increase. Then the one with restrictions is always going down, which you could think of it kind of like an expense to net income, decreasing net income, or like a contra revenue account if you so choose. But just note the debit's going to be a decrease to the items with restrictions, and the without restrictions, the credit will be an increase. Posting this out, then we have the debit is going to be over here to the one with restrictions, and then of course we have the credit to the one without restrictions. You'll note the net effect on what would be similar to the net income type number is nothing, because you could think of this kind of like as an intercompany type of transaction or an inter-fund type of transaction. It'll be taking from one kind of fund, you can think of it, to another type of fund, and you'll see that when we take a look at the statement similar to the income statement type of a statement. Now we're going to take a look at the cash that was going to be paid throughout the time period. Again, lumping these things together into summary type of transactions. For the cash that was paid throughout the whole time period, the whole month, the whole year. Interest expense, half to nursing services and half to the general service. So notice this is interest expense, but rather than recording it to the expense account of interest expense, which would be recording by nature, the type of account, we're going to be recording it to the function that it was used for, which is going to be nursing and general. So we're going to take that, we're going to divide it by 2, and then we're going to be recording nursing service expense and the general service expense for the 144 and the 144. Then we have the payment on mortgage principal. So we have the mortgage here. That's going to be a liability type of account. You'll notice we have a current portion and a long-term portion. Typically, if we make the payment, we're typically going to be making them out of the current portion. So I'm going to say we're going to have a debit of the current portion of the mortgage payable of the $545,000. Then we have the accounts payable for purchases. So these are cash paid, the payments that we made on the accounts payable. So accounts payable, you'll see that it has a liability account. It goes up Now we're saying that we're making the payment, the cash payment on it. Therefore, the liability is going to be going down. So we're going to be decreasing the payable there. And then we have the accrued payroll. Once again, the accrued payroll is going to go up when we process the payroll. And if we haven't yet paid the cash, and now we're saying cash is going to be paid, which will take that liability account back down. The liability has a credit balance. To make it go down, we'll do the opposite thing, a debit. Then if we summed all these up, the cash payments that we're going to group together, all cash paid, then being a credit of $2,954,600. Posting this out, see what it will look like. We've got the, let's see all of these at once. We got the nursing and the general. Let's keep those down here. That's the nursing and the general expenses. Increasing those two expense accounts, that would be decreasing then what would be similar to the net income type of number. Then we paid for the current portion of the mortgage payable. So if we go up to the mortgage payable, here's the current portion. We paid it all off because we're recording all of it throughout the entire year. Therefore, it goes down to 0. Then we have the accounts payable. Here's the accounts payable up top. We're paying the accounts payable off. Therefore, we're debiting it, doing the opposite thing to it as its credit balance, bringing it down. Then we have the accrued payroll. Here's the accrued payroll, has a credit balance in it. We're doing the opposite thing to it, debiting it, bringing that balance down. And then we have the credit to cash, going up to cash. We have a debit balance in cash. We're doing the opposite thing to it, crediting it, making the cash go down. Then we have the interest accrued on investment in assets. It's going to be limited to use. So this would be similar to an accrual process. The only difference here is that the cash amount is going to be the amount that's limited to use on the asset side of things. So we're going to be debiting the interest receivable, assets limited to use. So we're talking about interest that's limited. So if we go back up top, we've got the interest receivable, but it will be limited to use. So we're going to mark that there. And then the credit's going to be to investment income without donor restrictions. So if we see that posted out, then we're going to say that we have the interest receivable, assets limited to use, which we will be marking on our the balance sheet type of financial statement. Then we have the investment income. It's a credit balance. It's going up in the credit direction. As we do so, then we see that the net income type number also increasing. Next transaction. We've got the depreciation for the year. This is going to be the adjusting entry related to depreciation on the building and the equipment. This will be very similar as for a for-profit type of organization. The only difference being here that rather than posting the expense by the depreciation expense, we're going to be reporting it by function. That function broken out by these percentages: nursing services, professional services, administrative, and general services. So that's going to be the difference. You'll recall that depreciation represents the allocation of the cost of assets that have been capitalized. Therefore, things like the building, things like the equipment, we put on the books as an asset as opposed to expensing them at the point of purchase because they will be used in the future. And then we're going to allocate the cost of those items in the time period for which they will be used in accordance with the accrual principle of the matching principle, otherwise known as the expense recognition principle, same type of concept. So we have the asset then, the accumulated depreciation for it is a contra asset account. It would be increasing. As it increases, the book value, cost minus accumulated depreciation, goes down. Therefore, we're going to take these amounts then, and we're going to allocate them out. So you'll note that the accumulated depreciation looks the same. Normally, we would debit depreciation expense, credit accumulated depreciation. Accumulated depreciation related to the building and equipment still being credited. The debit, however, is going to be broken out by function: nursing, professional, administrative, and general, with these percentages. So if we were to take the 122,500 plus the 134 and then multiply it times 0.45, that's going to be the 115,425 going to the nursing. If we take the 122,500 plus the 134,000 times the 0.2, that's going to be what's going to both the admin and the general. So notice this adds it to 100 when you say the 45 plus the 15 plus 20 plus another 20, because we have the general and we have the admin. And then we're going to take the 122,500 plus the 134,000 times 0.45. I don't think I did that one for some reason. I did do that one. And then the 0.15, the 122,500 plus the 134,000 times 0.15, and that's going to be the 38,475. I think I got all of them. And so that will equal each other out because this adds up to 100 if you have 20 and 20. Recall that you have two 20s here to add to 100. That's a horrible 20. But anyways, it adds up to 100. I'm going to scratch that out. Let's just erase it. And let's post this out. So here we go. We've got the administrative expense. And then we have the general. We have the nursing. We have the other. So here they are posted. These are expense accounts. They have debit balances. They're going to be going up in the debit direction. As they do so, they'll be decreasing what would be basically the net income type number. The net income type number going down. The credit then going to the accumulated depreciation accounts. You can see that those are credit balance accounts. We will be crediting them, increasing them in the credit direction. As they go up in the credit direction, as we see these contra asset accounts, we can see that the book value then is going down. Next, we're going to take a look at the entry related to the inventory. When we are talking inventory here, we're talking about the supplies, the medical supplies inventory. So that's going to be up top. It's currently at 85,400. Now, typically when we think of inventory type of accounts, we can think of the item where we count the inventory at the end in a periodic system, and then we have to adjust the inventory to what we counted it to be. For example, in this case, we're going to say in year 2, we're going to say the current year we are in, we counted the inventory and we came up to 90,200. If we were then to do our adjusting entry, you would think that we would have to take this 85,400 minus the 90,200, and we would have to basically adjust upwards 4,800 to inventory. And that's what we will do. However, the other side of the account is typically going to go to inventory expense, and that's going to be the other side of things. Here, however, we want to break out the other side to admin, general, nursing, and the other professional expenses. Therefore, we're going to need more detail than just to know the ending count number. We're going to need to know basically the change in all of these areas, including the admin, general, nursing, and other. So now we need to basically, we got the beginning number and the ending number for these areas, for these functions that we will have. And then the sum of those total will add up to the ending number here. So you can imagine basically we're saying, hey, admin, you count up your ending inventory, general services, you count up your ending inventory, nursing, you count up yours, and so on. And then that'll give us our total ending numbers. This is what happened at the beginning of the period for our beginning numbers. So now we're simply going to take the difference then between year 2 and year 1, the current year and the prior year, per function, per admin, general, nursing, and so on, and then allocate that not to inventory expense, but to those areas, the admin, the nursing, the expenses by function. So if we take out the trusty calculator once more, we're going to say that for the admin, we had the 10,700 minus the 9,100. That's going to give us the 1,600. And that's, of course, a decrease from the current year, year 2 and year 1. Therefore, it's going to be a debit to decrease to show the expense related to it. Then we have the 11,400 minus the 1,3500. That's going to be the 2001 to the general. That's going to be down below. And notice it went up. So we're actually going to be crediting that item. Then we have the nursing. So the nursing is at 21,500 minus the 1,8600. That gives us the 2,900. It went down. So we're going to debit kind of like an expense. And then we've got the 4,180 minus the 4,900. And that doesn't look right. We got the 4,180 minus the 4,900, and that's the 7,200, and it went up, so we're going to have a credit to other professional service expenses. If we net these out, then of course we get the 1,600 plus the 2,900 minus the 7,200 minus the 2,100, which is our change of the 4,800, which of course is 9,200 minus the 8,540, also that change of the 4,800. So now we'll record this out. So if I record this out, we're going to say the inventory up top. We have the inventory starting at the 85,400. It's going to be going up by the 4.8 to the 90,200, which of course matches our ending inventory. We have the administrative expense down below. It's going up. We have the nursing expense down below. It's going up. And then we had the other professional expense is a credit. So it's going down. And then we have the general service expenses is a credit going down. You'll see that these accounts, of course, are the items that are affecting the net income. We have a net effect of the 4,800 a credit, which is actually increasing the what would be similar to the net income number. Next, we have the mortgage payable that is going to be due within 1 year. So you'll recall that we have the mortgage payable down here. We're going to say that it's going to be due within a year. This is a standard kind of adjusting entry we need at the end of the year, simply breaking out between the current portion and the long-term portion. Typically, we would get the amortization table to look into this. If you want more detail on amortization tables, loans, how to record loans, we do have a course on notes, bonds payable, long-term debt you could take a look at. So we're going to be doing this journal entry. We're going to be saying that the current portion of the mortgage payable, the amount that's due within a year, is going to be going up with a credit. It's going to be a liability account, therefore it goes up with a credit. And the long-term payable, the long-term portion then going down with a debit. If we post this out then, it's going to look like this. We're going to debit the long-term portion. Here's the loan payable long-term portion. It has a credit balance. We're going to do the opposite thing to it, debit it to make it go down. And then the current portion, this is the current portion. It has 0 in it because we paid it off this time period. And now we're putting 545 into it because that's the current portion a year from today. That brings it up to the 545. Notice that the 2 here, the net of the 2 mortgage payables is going to be equal to this 2,590,000 that it was prior. We're simply breaking out the current portion to the long-term portion so that we can report those on our financial statements. Next, we have an unrealized loss on investment of the 681. So we have an investment account. So you could think of them as stocks, and they went down in value. So we have to we're going to write down the stocks as they have decreased in value. And then the other side is going to have to go to some type of usually income or loss account. So we're going to say that we have the investment income that is limited to use. Investment income that's limited to use went down. That's going to be an asset account. Is up here. It's going down by the 681. And then the unrealized loss, so this is a loss that we have not yet realized because we have not yet sold them, is going to be going in the debit direction because it's a loss, kind of like an expense, decreasing what would be like the net income number. So if we were to post this out, then we're going to say that the unrealized loss on investments is here. Starts at 0. It's going to go up in the debit direction. That would bring down what would be like the net income number. And then we have the investments limited to use. So the investments limited to use then being a credit because it is going down.